Welcome to Everything Money. In this video, we will discuss the stock Bristol Myers Squibb. We will use our Everything Money software to show you the financials and the fundamentals behind this company and translate that into what you should be paying for this company using our stock analyzer tool. If you want to trade Bristol Myers with Mo, he will show you the charts and the trending charts on how to trade this at a quicker pace. But first, why should you listen to us? I represent you. I bring your normal person questions to a couple wealthy guys who manage over $100 million in real estate, stocks, and multiple businesses. This is no joke. They invest millions in companies and in properties and will show you their mindset on whether you should or should not be investing in Bristol Myers Squibb for both long-term or short-term trading. But first, I present to you Paul Gabriel.
Thank you, Seth. Guys, follow us on Instagram. We have a new Instagram account, and also follow us personally so our mothers are proud of us. Okay, so Bristol Myers Squibb. I'm going to go to our Everything Money software. Click on the 8 Pillars tab, BMY.
This is at everythingmoney.com.
Okay, so this company, let's look at the chart real quick. Not that it matters, but oh wow, look at that, Seth.
What in Lord's name
look at this. We love these stocks. Guys, look at this. In 2000, this stock price was really high. Call it $80. And it has it even passed that point ever? Yeah, it once hit that point in 2016. So guys, in 2000, if I told you this stock will go nowhere for 20 years, what would you say to me?
You're nuts.
You'd have said you're nuts.
Look at that rise.
Look at this rate, exactly. Somebody would have been saying, oh, look how stupid you are. Then I've been like, told you so. You'd be like, no, Paul, you're wrong. Oh boy. Guys, valuations drive drive stock prices over the long run. In the short run, you're gonna get bamboozled by this. But pay attention to stock prices versus their value. So, $130 billion company. The first pillar we want the 5-year PE to be under 22.5. This is 112. And guys, it has no PE because it lost $5 billion last year. So, Mo, why did it lose $5 billion last year?
Just last year?
Yeah, just last year. Pillar number 2, we want the 5-year return on invested capital being greater than 9%. Barely better, but it is good. It means they do a pretty decent job of investing the capital within the business. Now, Seth, look at this. Their dividend yield is pretty hefty.
That's not too bad. That's
no,
nice.
It's really good. 3.3%. Now, look at the interesting thing here, Seth. Net income last year was a loss of $5.5 billion, but their cash flow was a gain of $14.5 billion. So what does this tell me, Mo?
I'm sorry, I wasn't listening. I was looking for something else.
Oh, yeah, you're looking at the thing.
Yeah.
The net income last year was a loss of $5.5, but their free cash flow was a gain of $14.5. They probably had a write-off.
Yeah.
They probably had a one-time income charge that caused them, that wasn't based on cash, caused them that money. And their 5-year, so one of the things about dividend, guys, we want to make sure their dividend is sustainable. So their dividend costs them $4.3 billion a year. Luckily, because of our software, we put above it, the 5-year average free cash flow was 8.6, pretty much double that. It looks like a pretty safe dividend. Okay, so 1X and 1 check so far. The next pillar, we want to see income growth, revenue growth of the last 5 years. 19 billion, 45 billion. Check mark there. Pillar number 4.
Profit growth, yeah.
Profit growth.
Yep.
Net income, 4.23 to a loss of 5.4. That's an X. Now, I sat there and said there's probably a write-off. You ready, Uncle Seth?
What do you see?
Look how smart your Uncle Paul is. Other income and expenses, a $7 billion write-off.
What does that mean again to a dummy like me?
So when a company, it's a great question. When a company makes an acquisition, let's say they buy XYZ Corp for $10 billion. That does not mean a loss of $10 billion. That is an asset they put on their books. Let's say fast forward 3 or 4 years, they realize they overpaid. Let's say they overpaid by $7 billion. The IRS allows them to write that $7 billion off the $10 billion. Right?
Yes.
Okay. So that is that write-off there.
I see. Okay, a write-off.
Pillar number 5.
Shares outstanding, Paul.
Yes, we want them decreasing. And the reason being, shares, this is one of the most overlooked metrics and one of the most important. And all those other YouTube stars out there don't understand this because they are very stupid. You don't want the company issuing more and more shares and diluting you as an owner. It does not help the company, does not help you as an investor when they're doing that. So, we look at their shares outstanding. 1.64 to 2.22. That's an X. However, there's a big jump from here to here. There was probably some sort of acquisition made where they issued shares to make the acquisition.
Yes. In 2020?
Yeah.
Yeah. That was it.
What was it? What did they
It
buy?
was a company they bought called Myocardia.
How much did they pay for it?
$7 billion.
Oh, wow. Is that what they wrote off then too?
It's a $7 billion senior unsecured note that they did something to finagle in the Myocardia deal. That was
But there must have been a write-off there. Where was the write-off is the question.
Let me find it for you.
Yeah, so do like if you go to their 10K, which is found on our software. Either way, while Mo looks that up, pillar number 6, guys. Now,
Yeah, this involves their debt, Paul, and it's confusing for me. What's
we
the
got a
story?
great message the other day from somebody because my example is always, guys, if you and your neighbor have the exact same income, exact same house, everything, but your neighbor has 10 million in debt, you have 0. Who's more likely to go bankrupt? And the guy goes, I'm still trying to figure out how my neighbor has $10 million in debt.
Yeah, so you've honed it in. You've honed it into only $1 million in debt.
I have because I'm like, yeah. So we want to find companies that have reasonable amounts of debt because when times are tough, not through a market crash, but through a recession, we want to make sure that they can stick around because that's how you do best in investments, by avoiding the big fall. So we go back to our main page of our exclusive software. We go to the metrics. We go find their 5-year average free cash flow. In this situation, $8.6 billion. We multiply by 5, and that's $43 billion. So we want their long-term liabilities to be less than $43 billion. So we scroll up their balance sheet and scroll to the bottom. Ooh, $52 billion.
Too much.
That's an X. Okay, our final 2 pillars are based on cash flow. And guys, good news. There's a lot of math here, but we have a tab, 8 pillars tab that I'll show you when we're done with the cash flow to show you where this is all the shortcut for you. Now, guys, free cash flow is cash from operations less your capital expenditures. You can use that money to do 5 things: pay dividends, buy back shares, pay down debt, make acquisitions, and reinvest in your own business, right? So we take the cash from operations less the capital expenditures. Now, because your Uncle Paul is such a nice guy and part of the software, exclusive software, we added this line to the cash flow statement right here, so it does the math for you. 5 years ago, 4.43. Last year, 14.6.
Jeez.
Check mark. Oh, yeah. Over tripling. So that's a check. Our final metric, we want to come up with some sort of value to start at to say, is this reasonable? We take that same 5-year average free cash flow, we multiply it by 5, multiply it by 20.
Yes.
Multiply it by 5. $170 billion.
This is the desired market cap you'd like to pay for the entire company if you bought Bristol Myers.
As a starting point, yes.
Yeah,
Obviously, a faster growing company, you want to pay a higher multiple, et cetera. What is the market cap of the business?
$131 billion.
So versus 131, that's a check mark.
Actual market cap, 131. This is good, Paul.
This is good. So does that mean you go out and buy?
Yes. Oh, no. Sorry.
So first off, guys, here's our 8 pillars tab. It does all that work for you.
This is the screener you can use on your phone to not do any of this math and quickly screen a stock to see if it's in your wheelhouse of buying.
So I don't care about this because they had a big write-off. I don't care about this because they had an acquisition. The only one I'm worried about here is this one. And I don't care about this one either because it's based on that PE. This is the only one I'm worried about. I want to make sure their debt is manageable. Okay? So this software is all available because our viewers said, hey, how do I evaluate companies without waiting for you to make a video about them? Right? So we made the software. Spent hundreds of thousands of dollars, continuously spend hundreds of thousands of dollars for the software. You get everything you see here. There's an app for your mobile phone so you can take it anywhere you want. You get exclusive daily content, 2 or 3 videos a day that we send out to our users so they can watch all these videos, more videos that aren't available on YouTube. We've got a community of over 6,000 people who buy our software now that you can talk to on a minute-by-minute, hour-by-hour basis about every investment idea out there because we realize that people can feel lonely out there without somebody to talk to about these investment ideas.
I love when you say on an island because that's how I felt for a long time.
I think you've always said that.
Yeah, just lonely. I needed
help. And now you have 6,000 friends to talk to about this. And this is all available for only 90 cents per day. This is such a no-brainer, guys. If you can just increase your returns by 1 or 2%, you get all of this software plus everything we're making here on the right for 90 cents a day. You can make hundreds of thousands, if not millions of dollars extra for only 90 cents a day. 2 ways to sign up, everythingmoney.com or Patreon. The benefit of everythingmoney.com is you don't get double charged in the first month and there's no sales tax yet because we're not big enough. Now,
how does this transition, Paul, into what we should pay for this stock using that beautiful stock analyzer tool that you also get?
All right, guys. So this is one of the most important parts of our software. This stock analyzer tool will let you put in the assumptions about the future and tell you what you should pay for the company based on today. and the numbers you see for the future. Okay, so first things first. Let's put in 7 years of financial analysis, and I'm going to go with a low and high, 2 assumptions to make. Revenue growth. Now, guys, my goal is to be conservative and find the 20 or 30 out of the 10,000 stocks out there that when I put in conservative estimates, I do well with. I'm going to go with 5 and 8% revenue growth. Share change, I'm going to go with 0 and negative 1%. Profit margin, I'm going to go with 5 and 7. Oh, see, that's the thing. It's altered by that one big write-off. So I'm going to go with probably 12 and 15. Free cash flow margin, I'm going to put in 15 and 20. PE, 14 and 16. Price of free cash flow, 14 and 16. Now, why did I pick 14 and 16? Guys, it's a big company. The average should be about 15, so I go in between. I go on either side of them. For desired return, remember, guys, if you buy an ETF and just follow the market, you'll do no work and get 10% over long, long periods of time. So for me, to buy an individual stock, I want to make more money. I put 12.5% in. I hit the analyze button. The stock is currently $59. Actually, it's not terrible on the high side. It's actually right there if you're assuming that. And it's actually not even terrible on the low side. This stock is probably around a $50 stock where you can make good money on it. And if you believe my high assumptions, you're buying it today. You're absolutely buying it today if you believe these high assumptions. I'm not saying they're the right assumptions. You should do more research. But if you believe those high assumptions, you're buying the stock today and enjoying it.
If you're looking to trade this at a quicker pace, Mo, this up and down stock price, I bet if you follow the trends, you can get in on all of this action in the past 5 years because this chart's been up and down like a roller coaster.
It has.
If you're looking to trade this, you can join the BitNas Nation and join Mo on a daily basis. What's going on over there?
So the first thing I want to point out is we are below all 4 of our major moving averages. That's going to play a role here. Now, let's go over and look at something good that's happening here. So if we just zoom out just a little bit, we're going to look just past COVID. You notice that right in here, all of these little areas, and if you just draw a line straight across, you're hitting it. You are hitting a very strong support level. So what does that tell me? It tells me that this fall, this hitting a support level coupled with it's kind of at the bottom here and it's starting to turn back up on its stochastic, that tells me that it's getting ready to run to the upside. So if I was you, I would probably buy a tracker share on this. That's just one share, pay $59.49 for it, and wait for this red line to move into the sweet spot. Wait till you get those engulfing candlesticks moving up. This is looking like a very good trend, and this thing can definitely head back to $70. I think I might do this myself. I think I'm going to throw this into the BitNas Nation chat, actually.
I see a lot of people asking for Bristol Myers in the morning on your morning show. But if this
really?
I just see this coming up all the time. Yeah,
and I think people are getting excited because we are seeing that it's kind of a value play. I've noticed that people like to pick the companies that they see from value that they can trade to. So that I think their mentality, which you shouldn't have this mentality, is, well, if my trade falls apart, it's still a good value play.
I see.
You need to be able to separate the two. But
how can they do that with you, Mo?
You know, have two different accounts. Have an account for trading, have an account for value investing. That's what I do. I own a lot of Bristol Myers in my value account, but this is completely separate, and this is something I'm going to do in my trading account. So if you like this, and if you like these rules, and if you want to understand this process, come and join me in the BitNas Nation. You'll get all of the rules and the teaching tools that will help you learn how to do this. And if you've never done this before, I make it very, very easy for you.
You know, that's very important what Mo just said. If you have different styles, do different accounts. I have different styles. I have momentum. I have value. It's totally separate accounts because then you'll get too confused about, okay, why did I buy this one? Why did I buy that? Why is it? Just pick separate accounts.
I need to do that because I haven't been actually. So I was writing covered calls on long-term plays and it got all screwy now.
Oh, then yeah, you absolutely have to. And you can do that. You can probably split up your IRAs and all that stuff, right?
Yeah. That's our take on Bristol Myers. When they change their name, I'll be excited because it's goofy. But until then, keep watching our videos, fondle thumbs up, and we'll see you next video. Thanks for watching.